How does the Fed's discount window affect monetary policy? Imagine a safety net that keeps the banking system steady during tough times. That's what the Federal Reserve's discount window does. It's a tool that helps banks get quick short-term loans from the Fed when they need extra cash. This support keeps banks from having to cut back on lending to businesses and households suddenly. When banks can borrow easily, they keep providing loans, which keeps the economy moving smoothly. The discount window works alongside the main way the Federal Reserve influences the economy, which is through the federal funds rate. The federal funds rate is the interest rate banks charge each other for overnight loans of reserves. The Fed sets a target range for this rate to control overall borrowing costs and economic activity. The discount window's interest rate, called the discount rate, acts as a ceiling. Banks usually won't borrow from other banks at a higher rate than what they can get from the Fed. This helps keep short-term interest rates stable and close to the Fed's target. There are three main types of loans through the discount window. Primary credit is for banks that are financially healthy. Secondary credit is for banks that don't qualify for primary credit but still need short-term funds. Seasonal credit is for smaller banks that have predictable funding needs during certain times of the year. All loans are secured with collateral, like government securities or other safe assets, to make sure lending stays cautious. The discount window also influences inflation indirectly. When inflation is high, the Fed raises the federal funds rate to make borrowing more expensive. This slows down spending and helps bring inflation down. The discount window supports this by preventing short-term interest rates from rising too high above the discount rate. During economic slowdowns, the Fed lowers rates to encourage borrowing and spending. The discount window then acts as a safety valve, giving banks access to funds so they can keep lending. In the end, the discount window helps the Federal Reserve manage liquidity and interest rates. It keeps the banking system stable, supports the Fed's goal of controlling inflation, and helps promote steady economic growth. By providing a backup source of funds, it makes sure that credit keeps flowing and that short-term interest rates stay in line with the overall monetary policy goals.